Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. Today we're diving into three diverse, strong buy stocks to consider adding to your second half portfolio that might help you fight off any more coronavirus fears. But before we get into everything, I want to say, remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com. Also, make sure to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new zacks.com/promo page for a look in some of our services, portfolios, and more. So we're going to start with a little bit of a market overview, and then we'll jump into these three strong buy stocks. Stocks soared to start the week of July 6th, with the Dow up about 1.5% through mid-morning trading, and the S&P up about 1.6%, and the NASDAQ up about 2.5%. We also saw the Shanghai Composite Index soar to its highest level since early 2018. This big climb in China was a little bit hard to pinpoint, though. The Wall Street Journal noted Monday morning that a front page editorial in state-owned Chinese securities journal said that, quote, fostering a healthy bull market would be important amid the current economic situation in China. Then meanwhile, U.S. stocks continue to soar to start their strong July, with the NASDAQ hitting brand new highs and the S&P 500 closing in on around 3,200. These recent climbs come despite the fact that there are continuing to be spikes in coronavirus cases in parts of the U.S., including California and Texas and all of the states you've heard on the news. So with the numbers and the headlines continuing to increase over the last several weeks, economies around the world continue to emerge from their pandemic lockdowns, it seems that Wall Street has been more willing to look to the positives as opposed to the negatives recently, despite some of the near-term setbacks. And it is a little hard to think that the political will, especially during an election year, will be there for a second really broad-based lockdown. So that's kind of the assumption that Wall Street's operating under at the moment. We also had some impressive or stronger than expected economic data continue to roll in last week. And now it's worth to remember that the unofficial start of Q2 earnings season is next week with the big banks. So that'll be the next likely market catalyst. So with all of this in mind, investors might still want to look for strong stocks that are going to be able to grow despite the broader economic downturn and the uncertainty, that also provide exposure to this broader run, as we likely to remain in this don't fight the Fed mode for the foreseeable future at the moment. So we're going to now dive into three stocks that we're going to look at today from different sectors of the economy that are all Zacks ranked number one strong buy stocks. So we're going to start with ABBV, which trades under the ticker ABBV. This is a pharmaceutical firm that's portfolio features one of the world's top selling drugs, and that is Humira. But its patent protections are running out, especially outside of the US for that Humira drug, with biosimilars due in the States sometime within the next several years. So amid this, the company officially bought Allergan for $63 billion in a deal that was officially completed in May. So this is going to bolster its portfolio of drugs as it loses that patent protection on Humira. So this helps add Botox and other popular beauty-focused drugs to their portfolio. This now brings it to a bigger range of therapeutics alongside a strong R&D pipeline for AbbVie. And so far, Wall Street has seemed pretty pleased with the deal. ABBV stock is up 55% from the market's March 23 lows to outpace its industry's roughly 30% climb. The stock has now surged about 30% in the last 12 months. This also helps it crush the large cap pharma markets, about 5% expansion. And despite that recent positivity, the stock still sits roughly 15% below its early 2018 highs, which gives it some more room to run. And on top of that, it trades at a big discount compared to its highly ranked industry at about 8.7 times forward earnings against its industry's roughly 14.3 times. forward earnings. Meanwhile, our Zacks estimates are calling for ABBV's revenue to surge about 37% in fiscal 2020 and another nearly 18% higher in 2021. Obviously, a lot of that growth will be driven by its new deal to purchase Allergen. On the bottom line, ABBV's adjusted fiscal 2020 earnings are projected to jump about 18% and then climb another 14% higher next year. And as we mentioned with all these stocks we're talking about today, it has some strong positive earnings estimate revisions that help it hold a Zacks rank number one strong buy at the moment. We should also note that its dividend yield of about 4.8% blows away its industry's 2.9% average, and it easily tops some fellow large cap pharma stocks like Pfizer, Merck, and Eli Lilly, which has a yield of about 1.8%. So all of this might make investors want to consider ABBV for the second half as coronavirus fears and some volatility look poised to linger. Now we're going to transition to a completely different space, and we're going to talk about Dollar General, which trades under the ticker DG. The company sells everything really from food to motor oil at what they consider everyday low prices. So this is in contrast to its rival Dollar Tree, which does sell everything at that $1 price point. So DG operates roughly 16,500 stores across most of the United States. It's officially in 46 states, often in more rural and working class areas. And the retailer has really been able to thrive in an e-commerce age by expanding its brick and mortar footprint in areas where Amazon boxes might not be as common on doorsteps as they are in cities and suburbs directly near big cities. With that said, DG has rolled out its own digital offerings, and it's testing out its order online and pickup in store business at the moment. And if we look ahead, if we look back real recently, its sales have climbed at a high single-digit clip or higher for the last decade. We should also note that it topped our Q1 estimates at the end of May, with its sales up a whopping 28% and its adjusted earnings up 73%. Obviously, some pandemic stockpiling and more coronavirus uncertainty helped drive that growth. And the discount retailer could continue to grow as millions of Americans remain out of work, so that affordability is likely to remain attractive as it has been in areas where they continue to grow and expand their brick and mortar footprint. So with this in mind, our Zacks estimates call for Dollar General's Q2 sales to jump another 17%, with its full year fiscal 2020 sales projected to climb about 15% to roughly $32 billion. And this would mark its strongest growth since 2012. Meanwhile, its adjusted Q2 earnings and its fiscal 2020 earnings are both projected to soar roughly 32%. And like with all the other stocks, as I mentioned, has some strong earnings estimate revision activity, helps it hold a Zacks rank number one strong buy at the moment. And we should note that Dollar General stock is up about 40% since mid-March, and this is part of a longer run that's seen it crush Target and Walmart over the last 3 years. And despite outpacing its industry and sitting near its highs, DG still trades at a solid discount compared to its industry, and its current dividend yield tops the 10-year U.S. Treasury notes payout. And now we're going to end with a stock that's been in the news for most of the pandemic, and that is Zoom Video, which continues to remain a Zacks rank number one strong buy stock, trading under the ticker ZM. And as most people know at this point, it remains one of the unquestioned winners of the coronavirus stay-at-home economy for its ability to connect people via video, voice, chat, content sharing in general. So we should note that it did go public back in April of 2019, and it's now up nearly 300% so far in 2020, and it hit a brand new high on Monday morning. So if we look back to June, we should note that on June 2nd, the cloud-based video firm posted its blowout Q1 results, topping our earnings estimates by about 100%, with its revenue up about 170%. ZM closed the first quarter, and this is the very important growth on its customer side. It closed the first quarter, which ended on April 30th for them, with around 265,000 customers with at least 10 employees, and that was up a whopping 354% from the year ago period. And then in terms of its really big customers contributing more than $100,000 in trailing 12-month sales, that climbed 90% to about 770 of those customers. So that's going to be that continued growth metric to pay attention to, is able to capture more of these large business clients. So peeking ahead, our Q2 revenue estimates project its sales to climb 240%, with its full year sales projected to surge about 190%. Its bottom line is expected to soar even higher. 462% growth we're calling for this quarter to 45 cents a share, with its full year adjusted earnings expected to expand by about 240%. So some massive top and bottom line growth. Once again, positive earnings estimate revisions continue to have it at a Zacks rank number one strong buy. The stock also earns an A grade for growth, and it's part of a highly ranked Zacks industry. And some investors at this point might think it's too late to jump into Zoom stock, but people have been saying that for months, and the stock continues to hit new highs. Obviously, there could be a near-term pullback, and we don't know what the market's going to do, but it seems like a solid coronavirus play for its ability to expand while a lot of the economy contracts. And we should also note there's no guarantee that companies, especially in big cities with public transportation, will race back to their offices even as economies continue to reopen. Plus, the firm stands to benefit from a longer-term transition to maybe this remote environment that the coronavirus could have spurred forward, where companies might just sort of cut back on rent and commercial real estate expenses for the long haul. And we should note that Zoom was growing already before the pandemic, and the pandemic has kind of now just helped encapsulate why its business model is so strong, both during the current stay-at-home social distancing push and longer term down the road. And I wanted to close out today by just looking more broadly how these three stocks have done over the last year in the more recent past. So if we look since the market's March 23 lows, Zoom has been the winner, as most of you would have expected. It's up about 70% since then. Obviously, it's up longer or more, much more robustly in 2020 in general. ABBV stock, as we mentioned, is up about 54% since the market's lows, with DG up about 34%, which is actually below the broader S&P 500's nearly 40% climb from those lows. And now if we look at 2020 as a whole, we note that Zoom stock is up about 300%, about 293% to be exact. DG is up about 20% on the year in 2020, and ABBV is up about 12% compared to what is still a negative 3% return for the S&P 500 so far in 2020. And then if we look over the last 12 months, Zoom still that big winner, up about 200% over the last 12 months. ABBV is up about 40%, DG is up about 35%, and that compares all very favorably to the market's broader 6% return for the S&P 500. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions or episode suggestions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.